Warren Buffett has been acting strange lately. Over the past few years, Buffett has been quietly selling his biggest holdings like Apple and Bank of America. Buffett is a long-term investor who rarely sells stock in great companies, but in the past year alone, he sold over $134 billion worth of stocks. So what's going on? Warren Buffett recently dropped a bombshell that points towards exactly why he's selling his stocks. On February 22nd, 2025, Buffett released his annual letter to shareholders, and something odd happened in this letter. But to understand what's odd with his annual letter, you must understand the context. It's no secret that the market has been raging to all-time highs prior to Trump's new tariffs. Before the new tariffs were implemented, the S&P 500's PE ratio sat at 28, which was historically elevated. Because of this, Buffett's indicators are flashing red. One of the indicators Buffett uses for market valuations is the Buffett indicator. The Buffett indicator is the ratio of the total US stock market value to the US GDP. I'm using numbers before Trump's new tariffs because earnings will go down significantly and adjust to valuations. Prior to Trump's tariffs, the Buffett indicator sat at over 188%. Even during the dot-com bubble, the Buffett indicator peaked at around 140%. And before the 2008 recession, the Buffett indicator only peaked at roughly 105%. At 191% prior to Trump's tariffs, the Buffett indicator is in territories that indicate to us that the market is extremely overvalued. Buffett's actions point toward this as well. As of December 2024, Berkshire's cash and cash equivalents total to a whopping $334 billion. Buffett's total cash pile is up 99% year over year from December 2023 to December 2024. But where did all this cash come from? A large portion of this cash was due to Buffett slashing his biggest position, which was and still is Apple stock. Buffett sold over 600 million shares in Apple over the course of 2024, which leaves him with just 300 million shares of Apple today. But why is Buffett selling his position in Apple? There's no better person to tell you than Buffett himself. In the following clip, Buffett explains 3 reasons why he would ever stock up on cash. Pay attention very closely to these 3 reasons because this will be very important in analyzing his shareholder letter later in this video.
Investors behave in very human ways, which is they get very excited during bull markets and they look in the rearview mirror and they say, I made money last year, I'm going to make more money this year, so this time I'll borrow, or the neighbor says, I wasn't in last year when that neighbor was dumber than I made a lot of money, so I'm going to go in this year. So they're always looking in the rearview mirror. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say this is a lousy place to be. So they don't care what's going on in the underlying business. And it's astounding, but that makes for huge opportunity, just huge opportunity. I mean, I've lived through roughly half, in an investing sense, about half that period. And I've had that long period of stagnation from 65 to 82, 17 years. I wrote an article for Forbes in 1979. I just said, how can this be? Pension funds in 1970 put 100 and some % of their new money in stock because they were wild about stocks. Then they got a lot cheaper and they put a record low in, 9% of their net new money in 1978 when stocks were way cheaper. People behave very peculiarly in terms of their reactions because they're human beings and they get excited when others get excited, they get greedy when others get greedy, they get fearful when others get fearful. And they'll continue to do so. You will see things you won't believe in your lifetime and securities markets. And the country will do very well over time, but you will see these huge waves. And if you can stay objective throughout that, if you can detach yourself temperamentally from the crowd, you get very rich. And you won't have to be very bright. I mean, I'm sure you are, but it doesn't take brains, it takes temperament. It takes the ability to sit there and look at something. When I started out in 1950, I would go through and find things at 2 times earnings, and they were perfectly decent businesses, and people wanted jobs at those companies, and everybody knew they were going to be around, and they wouldn't buy them at 2 times earnings, and that's when interest rates were 2.5%. I started selling securities when I was 21, and a Kansas City life insurance company happened to be a fairly prominent company in Omaha, and the policies they sold you, if you were buying life insurance from them, had a built-in assumption of 2% interest. The stock of Kansas City Life was selling at less than 3 times earnings. You were getting 35% if you bought the stock. No question about the soundness of the company. I went to the local agent. I figured, hell, I ought to be able to sell him a few shares of stock. I mean, the guy ought to understand it. He's got his whole life invested in this company. I went to the local agent who'd been with him for 20 years, and his name was Moose. And I said, Mr. Moose, I said, you know, you're selling these policies with 2%. You may even have a few on members of your own family, and you can buy into this company whose paycheck you depend on every month, and whose future your beneficiaries of these life policies depend on, and who you're selling them, you know, a 2% investment on, and you can get 35% on your money. And he said, you know, stocks aren't any good, and I couldn't sell the, you know, I was a lousy salesman. I mean, well, you have to start with that, but it just blew me away. It blew me away. I thought. Sometimes I used to wonder if I was nuts, you know. But those things, the same thing happened. I mean, in 1964, the Dow closed at 864. At the end of 1981, 17 years later, it closed at 865. It moved 1 point in 17 years. Now, that's not a big move. And that, you can't believe how discouraged people were during that period. But, you know, people were living better. So things can go on a long time that don't make sense. But they do come to an end. I mean, the internet thing, I mean, you had these companies selling for many billions of dollars that had practically no prospects of making any money. That's a bubble. But Herb Stein one time said, anything that can't go on forever will end. Now that seems pretty, but think about that. And particularly think about it next time you're trying to do something just because the stock's gone up a whole lot, you know, and your neighbor's made money or something. You just have to sit and think objectively and think about, would I buy this whole business? If it's an internet company that's got 100 million shares out and selling at 100, that's $10 billion. Is it worth $10 billion? If it's worth $10 billion, it's got to be able to give you, you know, 700 or 800 million next year. And if it doesn't give you 700 or 800 million next year, it has to give you maybe 10% more than that the year after and continue to. There aren't a lot of businesses that can do that. And people just go crazy.
Did you catch those 3 reasons? The first reason Buffett would ever sell stocks is due to greed. Over the past few years, people have watched their stocks go up and have consequently gotten extremely greedy. It takes an objective mind to realize that these valuations simply aren't sustainable. The fact that the price of meme coins increased substantially in 2024 is a prime example of this. Meme coins like the Trump coin are obvious indicators of a bubble. There's no reason why the Trump coin should have been worth more than major companies. Taking a step back and realizing this is crucial. In every crisis, Warren Buffett has made billions of dollars. Whether it's the dot-com bubble or the 2008 recession, Buffett knows how to take advantage of every crisis. Now, he's currently preparing for one of the biggest crashes in his lifetime. Given the level of greed that he's observed, he knows that a crash will come. The second reason that Buffett mentions is earnings yields. As I mentioned earlier, the S&P 500's PE ratio prior to Trump's new tariffs sat at roughly 28. If we take the number 1 and divide it by 28, we get a result of 0.0357 or 3.57%. This means that the S&P 500's earnings yield is at 3.57%. So for every dollar invested in the S&P 500, the equity that you invested in will give you a total amount of annual earnings equivalent to 3.57 cents. Now pay attention to what I'm about to say very closely. If you take that dollar and invest it into 3-month treasury bonds instead, you would get an annual return of roughly 4.3% or 4.30 cents. So an investor in today's world has 2 choices. They can either invest their money in the S&P 500 for an annual earnings yield of 3.57% or invest that money in bonds for a guaranteed 4.3% annual return. Would you rather risk your money for 3.57% or take a guaranteed 4.3%? The answer is obvious, and Buffett isn't stupid. He knows that the bond market currently offers greater returns than stocks, so he's currently more inclined to invest in short-term bonds than stocks. In Buffett's lecture, he mentioned that back in his day, he could have either invested his money in an insurance stock and gotten an earnings yield of 35% or collected 2% in interest. Would you rather take 35% or 2%? The answer was obviously 35%. Now, we're in the same situation but reversed. Things don't make sense right now, and the market is inevitably going to have to correct for its nonsensical valuations. The third reason for Buffett to pile on cash is sustainability. How sustainable is the assumption that market valuations can continue to increase from here? If the market went up another 50% from here, what would the PE ratio be? The PE ratio is simply the market price per share divided by the earnings per share. Let's assume the market price per share increases 50% from here. If we take 1.5 and divide it by the earnings yield prior to tariffs of 0.035 0.57, we get 42.85. If we take 1 and divide it by 42.85, we get 0.023 or 2.3%. That means that the earnings yield would be 2.3% if prices go up another 50%. How sustainable is it for people to continue investing in stocks at a 2.3% earnings yield? How much longer can this nonsense continue? Can prices continue to go up from there? With the way the market is trending right now, a continual price increase is simply not sustainable. So the 3 reasons why Buffett would not invest today are greed, earnings yields, and sustainability. Now you might be wondering, how did this tie into Buffett's most recent annual report? I'm going to read some of his annual letter out loud, and we will analyze what he said together. In 2024, Berkshire did better than I expected. Though 53% of our 189 operating businesses reported a decline in earnings, we were aided by a predictable large gain in investment income as Treasury bill yields improved, and we substantially increased our holdings of these highly liquid short-term securities. All told, we recorded operating earnings of $47.4 billion in 2024. We regularly, endlessly, some readers may groan, emphasize this measure rather than the GAAP-mandated earnings that are reported on page K68. Our measure excludes capital gains or losses on the stocks and bonds we own, whether realized or unrealized. Over time, we think it highly likely that gains will prevail. Why else would we buy these securities? Though the year-by-year numbers will swing wildly and unpredictably, our horizon for such commitments is almost always far longer than a single year. In many, our thinking involves decades. These long-termers are the purchases that sometimes make the cash register ring like church bells. Despite what some commentators currently view as an extraordinary cash position at Berkshire, the great majority of your money remains in equities. That preference won't change. While our ownership in marketable equities moved downward last year from $354 billion to $272 billion, the value of our non-quoted controlled equities increased somewhat and remains far greater than the value of the marketable portfolio. Berkshire shareholders can rest assured that we will forever deploy a substantial majority of their money in equities, mostly American equities, although many of these will have international operations of significance. Berkshire will never prefer ownership of cash equivalent assets over the ownership of good businesses, whether controlled or only partially owned. Paper money can see its value evaporate if fiscal folly prevails. In some countries, this reckless practice has become habitual, and in our country's short history, the US has come close to the edge. Fixed coupon bonds provide no protection against runaway currency. Businesses, as well as individuals with desired talents, however, will usually find a way to cope with monetary instability as long as their goods or services are desired by the country's citizenry. So too with personal skills. Lacking assets such as athletic excellence, a wonderful voice, medical or legal skills, or for that matter any special talents, I have had to rely on equities throughout my life. I have depended on the success of American businesses and I will continue to do so. There are a few sentences that are extremely important in this report, and the reason why I chose these sentences to read out loud is of paramount importance. First of all, I want to repeat the following 2 sentences. We were aided by a predictable large gain in investment income as Treasury bill yields improved, and we substantially increased our holdings of these highly liquid short-term securities. Over time, we think it highly likely that gains will prevail. Why else would we buy these securities? These 2 sentences highlight how Buffett believes that the current valuations of equities do not make sense. He's only going to purchase stocks if he believes that gains will prevail. Right now, he's selling marketable equities and allocating more money to bonds, but this is only a temporary move. As Buffett mentioned, Berkshire will never prefer ownership of cash equivalent assets over the ownership of good businesses. Buffett clearly still believes that equities will prevail in the long term. His purchase of bonds is not due to favoring bonds over the long term, but rather the short term. When the market crashes, Buffett will inevitably reallocate his portfolio from bonds to stocks once again. The long-term game has always been in American businesses, and that will not change. So Buffett is reducing his marketable equities right now for one and only one reason: the market is overvalued. If you enjoyed this video, please give it a like and consider subscribing to the channel. I'll see you in the next one.